do that. Thank you. Thank you for the kind introduction. Um, really looking forward to sharing some strategies that we've implemented many times, and astoundingly, um, many CPAs and lawyers seem they're unaware of the value and benefit. And before I pull up some of the slides, I wanted to share that uh, the strategies that we're going to talk that when Ed and Doug talk about the MSO, we don't want to forget that there are many folks that have had a C corporation for a long time. In fact, that may be their primary entity through which they operate. So that would not be uncommon. And many of the same C corporations have retained earnings. It's called retained AAA or retained D&P. And these are monies that they've already paid corporate tax on. They've accumulated. They've used these funds to grow their companies, and we also see, besides implementing MSOs, we also come across, especially through accounting partners of ours, entrepreneurs who already have an existing C Corp that would like to do something a bit more constructive or transcend the tax code and reposition assets in a way that doesn't cause income tax liability. So I'm going to talk about two strategies today. Hold on, let me just pull this up. And let me see. Get that right. So this should really be not necessarily MSO C Corp, it's just a C Corp efficiency model. And certainly for folks that have already accrued or accumulated, either going to accumulate less costly dollars or have already done so. So I'm going to talk about two different methodologies where we can use these, let's call it after corporate tax dollars, but pre-income tax dollars and pre-dividend dollars effectively. So you've already seen these slides, and both Ed and Doug I'm sure have already talked with you a bit about some of the other benefit plans, the other benefits that can come under the C Corp. So I think I'm hoping that I'm going to show you something that you haven't necessarily seen today that we use in a couple of different environments. So I guess you could say, so part of this is for the client who either has a need for life insurance for either buy-sell reasons with a partner, or they are the goose that lays the golden egg. They are a key person, key entrepreneur, life insurance, or may already be paying for life insurance with after-tax dollars, expensive after-tax dollars. And we ask them a question: what kind of risk management are you providing for yourself or your family? Or maybe owning life insurance that may be outside the estate in trust, but are having to gift a lot of money to pay the premiums, triggering funding of either a gift tax return and or using after-tax dollars. So the philosophy is why would anybody pay for life insurance with an after-tax dollar if they don't have to? Very simply. So certainly here in California, we could say income and federal state income taxes are about 50.3% on the highest level. So I'm going to share with you a program that's incredibly tax efficient. Tax efficient means either less cost or more coverage. And in this case, I'm going to share with you a program that a client of ours, this came from a joint venture partner whose client is very wealthy. and was planning on buying some life insurance. In fact, our JV partner sent us 3 different life insurance policies and said, my client, or I should say it was a prospect at that time, it's a client now, my prospect is considering buying $75 million of life insurance. Is there anything that we can do? So they have a C corporation now. So in this case, let me get right down to it. So hold on. So this is an analysis, an illustration on the left that was sent to me. So all we're talking about, here is efficiently using C Corp dollars in order to acquire life insurance. So his client told him, I'm considering buying $25 million of life insurance on my wife, on myself, and a survivorship life policy. And I want it outside of my estate. So I said, please send me the illustration that you're looking at. 2 of them were for guaranteed coverage, and this is what he sent me: a nationwide 20-pay policy. And this is a client, actually, this particular client's down in Florida, so there's no state income tax. So in this case, we said, well, your premium on the policy, there's 2 issues. The first is, here is the cost, $170,000 a year for 20 years. The insurance agent is asking the client to pay for this with after-tax dollars. So I had the client, the accountant, and their attorney on the line. And I said, well, would it be fair to say, since they're asking you to pay for after-tax dollars, would a pre-tax dollar would be $270,000? You have to earn $270 to net $170 after tax. And the answer to the accountant said, sure, that's really quite reasonable. I said, so the real cost of this is $270 pre-tax. He said, absolutely. I said, okay, so in 10 years, if that's the case, you would have had to earn 2.7 million in order to, or earn 2.7 million and gift 1.7 outside the estate in order to have a $25 million policy. And in 20 years, you would have had to earn 5.4 and also use gift tax exclusions of 3.4 in order to fully guarantee this 25 million. Does that make sense? On the right side, client already has a C corporation, it's a retained E&P, and the premium, I said, well, let me use a fully guaranteed policy. They have monies inside the C corporation, and at a 21% discount from monies that were there, wouldn't that cost you $280,000 versus $355,000? If that's the case, the actual cost of the policy is significantly less. I've got a policy here that we've paid for 8 years. This is the applicant, owner, and beneficiary of this key person policy is $280,000 a year, $10,000 more. In the 9th year, the cumulative savings on using less expensive C Corp dollars mounts up really quite quickly, so that over 20 years, the cumulative savings is about $3.1 million. I showed this, the accountant said, I'm going to have some questions. I said, I'm sure you will. I said, let me just go through and show you all 3 and then listen to the questions. Here is the cost for him, 244. Here are the savings over 20 years. And here is the cost for a survivorship, same survivorship policy. So if we were to look at the gift taxes, the gift taxes that were used, 3.4 million here, another $5 million second, and another $4 million, so a little over $12 million on the left side of gift tax exclusion, meaning client would have to write a check to a trust, file a gift tax return. You're going to use about $12 million of gift tax exclusion. On the right side, if we were to add up the savings over 20 years, you're going to see $5 million of savings on the survivorship, $4 million on his policy, and $3 million here, about $12 million of savings. And then I stopped talking. The accountant said, I appreciate what you said, but I really don't think that you're comparing apples to apples. And, I need to make this clear to my client because I don't believe that you're doing a correct comparison. I said, okay, share with me what your initial concerns are, and let me try to answer your questions one by one. He said, well, in the blue column, a trust is buying the policy. Granted, we're paying for it with after-tax dollars. I agree there. And I agree that we're using gift taxes, but on the left side, the $25 million is outside of the client's estate. I said, yep, that's right. He said, isn't it true on the right side of the equation that you're buying the policy, that the applicant and owner of the policy and even the beneficiary on the policy, aren't you buying a key person policy, key man policy? I said, yes, that's right. He said, well, that's where I have the problem. If the client passes away, then the death benefit would come into the corporation, right? I said, yes. He said, that would mean that not only to get it out of the company, it would be includable. It would be subject to a 21% dividend tax. I'd say, yes. He said, then you have a 40% estate tax. I said, that's right. He said, there, I told you this wasn't an apples to apples comparison. And I said, well, this is what's unusual. I said, everything that you said is true, but I haven't shared with you the whole story. On the right side of the equation, this policy where you see, if you note, I wrote after estate taxes, death benefit. I said, I apologize. That should have been after corporate tax and estate taxes, the death benefit. He said, what do you mean? I said, the policy on the right side is a fully guaranteed permanent life insurance policy, except I'm not showing the fact that it actually has two riders that are embedded in the policy, and I just didn't make it clear. I apologize. There should have been a column in between, maybe even two, in between the cumulative savings and the after income and estate taxes. He said, what are the two columns? I said, well, there is a corporate income tax rider such that there is enough death benefit that will pay the 21% corporate tax, getting the policy out of the plan. And then there is an estate tax rider that will pay the estate taxes, so that the policy on the right actually has cumulative death benefits of approximately $55 million coming out of the gate, and those benefits actually exist for 10 years. He said, that's astounding. He said, what you're saying is that you, even though this is a corporate-owned policy and you're paying it with cheaper corporate dollars, you're saying you have a special policy design that both pays the corporate income tax and pays the estate tax, so that what's left over outside the estate, income and estate tax free, is 25 million. Is that right? I said, that's exactly correct. I said, that would be consistent through all three of these diagrams. He said, that's really quite incredible. I'm going to ask you to demonstrate that. If you can demonstrate that for me with an illustration, I'm going to tell my client to move forward with this. I said, well, I'm not done yet. He said, what do you mean you're not done? I said, well, in the case of this policy, it's a fully guaranteed policy, and it has virtually no cash value. During the first 8 years, this policy is inside of the C Corp. What we do is we're going to bonus this policy outside of the C Corp. And when I say bonus, literally the cash surrender value, which is the correct value from the IRS's perspective, that is the value that the IRS tells us to use. There's a specific form that we fill out, and we bonus the policy out as compensation, and it is literally a few dollars. So the owner, we bonus it out. Mrs. Thatcher or Mr. Thatcher receives that policy, takes it in as income, and then we turn around literally after we've changed the owner and beneficiary. Literally the next day, we sell that policy to the client's irrevocable trust or generation skipping trust for the cash surrender value, which is exactly the measure that the IRS tells us to use, black letter law, and we sell that policy and we get it outside of the estate. And so what we've done here is we have, during the time that each of these policies are inside the company, in the case of survivorship, it's even a shorter period of time, but during the 8 years, while the policy is inside of the plan, there are 2 riders that would cover both the corporate tax to pay it out to the family and the estate tax. Then we bonus it out, and now we have a perfected policy. I should say we don't quite have a perfected policy. We have an almost perfected policy. So now I have a policy with approximately $55 million in death benefit from at the end of year 8, 9, and 10. And in order to perfect this policy, I notify the life insurance carrier in the 10th year that we're eliminating the riders. And when we do so, and this is contractually stated in the insurance contracts, contractual guarantee, we have a policy that will stay in force without any additional premiums. In this case, I've designed it minimally to age 100. It could be 105. It could be age 110 up to 121. I haven't used any gift tax liability. And if I'm comparing after tax dollars, I've saved almost $12 million in doing so. And when I explained this to the accountant said, I've never, ever seen anything like this before. I said, I understand. 65, I've been taking apart life insurance policies and negotiating with carriers and structuring special policies for specific purposes for most of my professional life. this is unusual. He said, is there anything else? He said, I got it. What I expect in order to tell my client to move forward with this, I want to arrange another meeting where you'll please provide me a specimen policy that shows and demonstrates exactly what you're saying. I said, that's no problem whatsoever. Let's go ahead and do it. He said, is there anything else that's unusual in here? I said, well, as a matter of fact, there actually is. The other thing that's incredibly unusual in here is that both of these riders are underwritten at the inception of the policy. And it's a unilateral option, meaning the client, in this case, the company initially, and then the trust, has a unilateral option to provide the one page that removes that removes these options and provides a fully guaranteed policy. The other piece of flexibility that's incredibly interesting is that if this client has a health change in any of these 10 years, the client can write to the company and let them know, I'm electing not to remove these riders, and I want to keep 100% of all of the coverage. Now, there's two questions that come beyond that. First question, the first normal question would be, that's really interesting. So what you're telling me, I've got an extra $30 million of coverage on top of the 25 that was perfected that can stay in force till age 100, but it's going to require more premiums. I said, that's exactly it. You can have anywhere, actually somewhere between, or the whole thing, 25 and 55. He said, well, how long, just curious, how long will the policy last at 55 million if I didn't put any more premiums into it? I said, till age 86. And this seems, it's very counterintuitive, but the policy, I can demonstrate it's contractually guaranteed. He said, well, if I want it to last, how much money do I have to put into the policies to keep the policy last? I said, well, tell me when you want to put the money in and over what time period, and I'll tell you exactly how much. It's fully guaranteed coverage. So what I'm sharing with you is a methodology that is so much less costly than I think any of you have probably ever seen. And I will tell you, this is the same philosophy and type of cover that we use often, not always, when we move monies out of retirement plan, profit sharing plans, or rollover IRAs without triggering income tax when clients no longer need these assets. So one utilization of C Corp dollars is perfecting either guaranteed or non-guaranteed coverage. In this case, it could be buy-sell. It could be for legacy, wealth transfer, and liquidity. It could be key person coverage. And maybe the last thing that would be of value to share with each of you is this. The same policy, not with all carriers, but with a couple of carriers that, and we're carrier agnostic, that we deal with. If the trustee of this trust, for whatever reason, no longer wanted any of these two individual policies, the trustee can contractually put the policy back to the carrier and receive 100% of the premiums that have gone into the policy back, no questions asked. It's called an ROP option, return of premium, or a put option. And so for many of folks, unless you're an insurance geek. I would definitely call myself a bit of an insurance geek, you might say, or risk management. Insurance is not for everyone, but so many of us need different forms of risk management, and it makes sense. And so, what I'm sharing is simply a wonderful philosophy that can make a tremendous amount of sense. So, let me stop for a moment and answer some questions before I share with you the income. So we have a process where where business owners can use the same pre-tax money and create a tax-free supplemental executive retirement plan using these C Corp dollars. So let me stop talking and see if I can entertain some questions.
And Jason, if I could, I'd like to do a quick summary and why this is so important for the people on this call. With 2026 coming around the corner, with TCJA due to roll back unless Congress intervenes and either extends, puts a patch, or comes up with new tax law, a lot of our successful business owners about to be really subject to estate taxes. And one thing Jason said that hopefully you made a mark on your notes, the strategy that he's proposing here does not require gift or any type of lifetime unified credit carve out on behalf of the client, which means instead of us burning up their lifetime unified credit to pay for life insurance premiums inside of an ILET or something, they're getting to preserve their lifetime unified credit so they can do normal planning on their personal side of the table. The structure here, you're using discounted dollars to solve not only just one or two tax problems in a very tax efficient way, but the key component here is when you think about succession planning, strategic business planning, qualifying the client for loans to expand the business. I mean, all of those things start coming into play where if we were just doing regular life insurance planning inside a life insurance trust using up their lifetime unified credit, that business owner is going to be so handicapped by that level of thinking that they're going to be blown away when they see something like this. And so if you got a question, let's open it up real quick. Jason, it is 37 minutes after the hour. So does anyone have a question they'd like to hit Jason with real quick? Hearing none, Jason, hit it, man. You got about 15
Sure.
minutes.
No problem. So if any of you would like to see this or talk about it in greater depth and see what we're doing with qualified plan assets too.
Jason, if I could interrupt you,
You
I
bet.
had a question. I was on mute. Do you mind if I ask the question?
Oh, please go right ahead.
So it's a basic one, Ed. I learn things by osmosis and iteration. I did learn not to ask any questions about rugby today, so I'm getting smart at it. The reason why, Ed and Jason, this doesn't impact the lifetime unified credit, is it basically because all of it's being done under the auspices of a C Corp / MSO? Is that the deal?
No, well, part of it. The other
Okay.
part of it is that it has to do with the policy valuation of a guaranteed policy that's owned by the C Corp and then owned individually. So the IRS, for example, if a policy is owned by a retirement plan, the IRS has spelled out a revenue procedure that says this is what the value is. When it's owned by the C Corp, they have a different methodology where they've spelled this out and codified this over 20 years ago. It's literally cash surrender value of the policy. It's not a tax reserve, interpolated terminal reserve. The reason why it has no gift tax is that it basically has no cash value.
Oh, okay.
Yep.
I
So
think I get it.
that's
Ed, you know the drill. I'll be asking you about it.
and
And
whereas
you'll
the
go to the
cash value
whiteboard.
policy should be held on the personal side of the ledger. Does that make sense?
Yeah, I think that it does.
Actually, all right, give me 1 second. Let me pull this up.
Good question, Ron.
Thanks, Ed. It's a lot of information here. It's very good. It's got to learn it.
It is complex, but as we move into post TCJA in 2026, we're all going to have to step up our game, unless we just want to work with people who are living on welfare and unemployment.
Yeah. Which is tax-free welfare.
Yeah. So, sometimes when Ed and I are introduced to an existing accountant says, well, I have a C corporation that has quite a bit of money. This is actually easy to overcome. Sometimes the question comes up of IRS Section 531 for C corps that have accumulated too much money. They say that there could be an accumulated earnings tax. We know what happened with TJTC. So I think I'm going to get right down to it and just talk about what we do with monies when it's not necessarily a death benefit that, and this is actually a plan that we implemented in 2022 on behalf of a client. They had a long-standing C Corp, I think since 1983. Hold on a second. That they've had since 1983, and millions of dollars. And the two owners, husband and wife, and they had an outside family owner own a minority interest. They said, is rather than declaring a bonus, is there a methodology or way where we can provide ourselves some additional income? And so what we said is, sure, there is a methodology of acquiring very high cash value life insurance with these pre-tax dollars in the form of a loan. This is called loan-based split dollar. So the first calculation that we did is we said, well, if we're talking about using $1.2 million, if we just bonused it out, you're looking at some fairly significant tax erosion, a little over 41%, 42%. And if you bonused it out, there's only going to be about $700,000 left after the income tax liability. So I took the names off this, just called them JW. I said, well, let's take a look at what happens if we were to actually take the money out, pay a bonus, and accumulate those funds in a tax-free account and guarantee it at 4%, and then start taking income. I could start taking income at 76, or this person's 67. They're a little bit. If I had my druthers, I would implement this for somebody that's actually a bit younger. It still happens to work remarkably well. So in this case, all we did is distribute, pay the tax, invest the funds, and then start taking supplemental income that lasts for, approximately for 20 years. So if we did that, you would expire, we constantly got 4% tax-free, you pay out about $2.9 million. If I did that on his wife, same deal. I could take it a little bit earlier. It got a little bit more than 20 years. Actually, I take it back. I paid it for the same 20 years. She's just a bit younger, still $2.9 million. So in this case, what we're establishing is a supplemental retirement plan. This has been around a long time. This is also done in not-for-profits called the Harbaugh Plan, best known for Coach Harbaugh of Michigan State, that didn't want to pay all the tax on his income. So similar, very similar type of structure. What we're doing is establishing the corporation is making a loan in the form of a life insurance contract that whereby either all of the interest can be accrued and paid at death, or can pay interest along the way. And that loan can be the rate can be either a short, medium, or long-term AFR loan, applicable federal rate. Certainly a couple of years ago, it was a little bit less. We find it going down a bit from the high from where it was recently. So if we did this, and at the time that I implemented this, the AFR was 3.43%. We had the same $500,000 going in, or $2.5 million going into this policy over 5 years. We just leave it alone, let the policy cook a bit, and then take distributions over a 20-year period. Instead of having a little less than 3 million, we've got about 4.4 million tax-free. Here, about 4.6 for client's wife. And if you'll notice the death benefit, on the right, I'm always paying back. I always have enough money. So the calculation here is that I always want to leave enough death benefit to pay back the loan. So some clients say it would not be unusual for me to couple this program, loan-based split dollar, with the first. So meaning that this is basically a very effective use of putting 100 cents on the dollar to use in the form, in this case, this is an indexed universal life policy. We're carrier agnostic. I don't really care where it goes to, except to say that anything we choose has to be most effective, stand the test of time. And I think what I'll say here is that in almost every instance, we tend to use mutual life insurance carriers because they tend never to screw the client. They're owned by all policyholders own mutual life. This can also be done with a traditional whole life contract. I've done it that way as well. So just think loan, payback someday when the client passes away, and taking tax-free income in the future. So this would be an effective use of C Corp dollars that have not yet been taxed in order to either create golden handcuffs for key employees or supplemental retirement income for owners of the company, subject to some control group rules. So in order to put that in place, both of the owners, in this case, I had the fact pattern in place, husband and wife would need to be less than a 50% owner. So that fact pattern already existed in this plan, would not be implementable for somebody that was an 80% or 100% owner. In order to put that in place, I would have to change the ownership, could be even among family members, such that no party owned a controlling interest. So that's just another way of using pre-tax effective dollars. There's 3 or 4 different ways to soak monies out. You might say reposition is really, soak monies out, probably a bad word. Reposition assets in a tax smart way that will stand the test of time, will be legal, and will stand up under any type of audit or scrutiny. We have to always assume that there's going to be an audit. And so we know that all of our clients, while nobody likes an audit, this has to show up clean and pristine We have to be able to answer our clients' questions. So that is another way of using these pre-tax dollars in order to create selective benefits for key people or owners of the company. Let me stop here.
Jason, great job on that. And we've got a few minutes here before we have to close at the top of the hour. And I'm going to ask Doug Dickey to provide some summary comments here as well. The key thing that I've seen over the 24 years of doing tax planning is a complete ignorance of how to use a C Corp for too many ways. Doug, would you be willing to add a few comments about some of the things you've seen over your many years as a CPA partner?
Sure. I mean, the good and bad that we've seen, in these is that, people don't understand this issue of double tax. They think it has to be forced out. It doesn't have to be forced out as long as there's a legitimate business reason to be able to accumulate it, as Jason alluded to in Section 531 and 537. So those issues of accumulated earnings tax are really kind of non-issues. These issues of being able to exit the cash, to the extent that you want to, that's fine. You can also take the assets and move them along to the next generation. You can establish the C corporation to begin with outside the estate, set it up and owned by family limited partnerships or trust, right? A C corporation can be owned by anyone or anything. And so it just depends on how early in you are in the overall structuring of the business itself. But what Jason's talked about here today is excellent from a standpoint of how do you discount the value that you're growing and move it to the next generation to preserve it, right? You've got a C corporation that even just under standard federal tax rates, 37% individual versus 21% corporate, that 16-point spread is a serious amount of additional accumulation per year. It's basically like accumulating another year worth of profits every 4 years. If you take that and continue to grow it, you can see the compounding effect that would have over time. You couple that with reducing the cost for servicing things like debt by 42%. So, in a commercial real estate environment where somebody's got a 70% loan to value, that gives you basically a 28% reduction in cost of ownership, right? 42% of 70%, 28%. Plus a reduction in the amount of interest because you're paying it off sooner, presumably. So this just allows you to continue to operate and earn dollars, but move them into a more tax efficient environment. Once it's in the tax efficient environment, do you want to continue to accumulate them there? Do you want to move them out and put them into other structures for estate tax purposes or for wealth transfer purposes? It doesn't have to stop with a C corporation. And so these are just mechanisms to be able to better structure people's activities and holdings now and into the future. So, there isn't one size fits all for this. It's just planning based upon what their particular circumstances are. Like what Jason was alluding to, control group rules do come into play here to some extent, and these structures. And so maybe you have to do some restructuring of ownerships going in, but they're generally not insurmountable hurdles to clear.
And Doug, would you also touch real quick, because we talk a lot about building the value of the business. And we also talk about the tax efficient exit of the business and retirement and wealth transfer. Let's pretend for a moment that we have a client with 3 McDonald's franchises, all structured as S corporations, and they have the C corporation. They've got the MSO, MSA, and MFA all in place, and they decide to sell the 3 McDonald's corporations, their 3 franchises. What happens then to the C corporation, and how is it used by the client?
Sure. First off, what the value is to a buyer is the McDonald's, right? They're buying the operating companies. So it's either going to be an asset sale or a stock sale of the operating companies, not of the management company. You would go through and do a normalization of earnings process like you would on selling any business to make certain that they get full value for the operating companies. But the buyer will not buy the management company. They can set up their own management company if they want. So that management company becomes, in essence, the family office structure for the client, not necessarily them running their family office, but the entity through which they will manage their holdings. Because when an entrepreneur sells their business, they don't go home and sit on the couch and eat bonbons all day long, right? They manage other assets. They continue to have needs for their family and benefits for their family. Well, that C corporation continues to be their family management company, whether you want to call it a family office, a family management company, it doesn't matter. That's its functionality. It's continuing to operate long after you sell those franchises. They may sell those franchises and get bored after a year and go buy something else, right? That's not unheard of because our entrepreneurial clients really don't retire very well. And so that management company continues to be just that, a management company for their activities, whether it's investments or it's operating companies or real estate. They still need to have a business structure from which to operate.
Yeah, thank you. Well, folks, we got a couple of minutes here before the top of the hour. Do you have any questions for Jason or Doug? And you can always email me your questions, and we're going to put together an email response. We didn't get a lot of questions from the first one, but if you have an email with a question that you don't want to ask here, just send it to me and we'll get it and add it up to. But anybody got a question for Jason or Doug?
Anything from Oz?
Yeah, one quick one maybe. Ed, you talked about some time ago a life insurance partnership trust where it takes out most of the life insurance benefits out of the estate, but we can generate an income and it's a lot more flexible mechanism. Does this tie into what Jason is saying also?
Potentially, yeah. The life insurance limited partnership is another way to push assets outside of the taxable estate to where 95% of the assets inside of the partnership would be free of estate taxes, but 5% would be retained and added to the 706. And so similar to the ILET, but the life insurance limited partnership does give you a little bit more flexibility to do some more creative planning. Good
Yeah, I could show you. There's a little bit of Ken. There's a combination of the two. You can. What you're saying is that can I have my cake and eat it too? Can I use the pre-tax corporate dollars, pay the company back, have both death benefit and cash value outside the estate? Yes, we can do that. It's a facts and circumstance, but yes, we can do that.
And I also want to premise with, the example Jason showed was $25 million. Folks, you can do this for $3 million. You can do this with $100 million. It's just don't focus on the death benefit value or the premium payment cost. The point is, what is the mechanism that can help my client get the coverage they need with discounted dollars?
Yeah. I never like to pay like the other thing to keep your eye out for. It's just so onerous here in California, New York, and other states. I just hate having clients use their after-tax dollars. We all sweat hard to get to a point to use our money. I just hate seeing those expensive dollars used for risk management. And, I got to tell you, for a client that has a normal life expectancy, well into their late 80s, early 90s, mid 90s, buying life insurance with an after-tax dollar, and those internal rates of return when we get to that age are like about 3 or 4%. I mean, they're just a bit abysmal. The only way to get higher is to use some incredibly expensive whole life contract, which makes no sense whatsoever. And so we're used to clients just asking that question. Have you ever considered refinancing your life insurance? Are you using those expensive dollars? We may have a better way. And so for literally since 1983, this has been codified back since the 1960s. You could use pre-tax dollars to acquire necessary risk management, and transcend the tax code. It's transform a pre-tax dollar and get that policy out of the plan at a fraction of what went in it legally, and even precisely according to the IRS's rules, and generate a 75 or 80% discount. It's really effective. It's not springing cash value, none of that garbage. This is just a smart way to use tax hot assets. I think Doug uses the term hot assets, which can be doubly taxed assets, to acquire risk management or satisfy liquidity or buy, sell, just keep your eye out for that, because this can be hundreds of thousands of dollars in savings, if not millions. And you don't want to ignore it. It's a good thing.
Well, folks, we're at the top of the hour. Jason, Doug, thank you very much for 2 hours of dynamic training and information. This wonderful information. Again, folks, if you have a question, feel free to send it to me an email. We'll compile all these notes. Thank you very much for being with us today, and roll Tide.